again, so I'm Laura Beacon. I'm with SBDC. I'm one of the consultants. Our entire team is available to you for one-on-one consulting or a group pitch review. I guess we don't always mention it, but there's an option for you to also get feedback from all of us. If you have a pitch deck and you would like to get professional review, we do that as sort of investors. We put on an investor hat. We'll listen to your pitch. We evaluate you. We ask questions, and then we'll provide feedback. So that's in addition to one-on-one consulting. That's something that you can always take advantage of. So we're happy to have both Paige and Monica. We have presented together before. So I will let them introduce themselves and tell you a little bit about their background.
Good morning. My name is Monica, and I am a certified business performance advisor with Insperity. Insperity is a 35-year-old HR outsourcing company focused on small and mid-sized level businesses. And we help our clients understand job costing for their employees, compliance-related issues, and really managing their employees from an HR perspective. So I'm looking forward to learning about everybody today and sharing a little bit of information about myself, Insperity, and how to have an investable startup.
Good morning, everyone. I'm Paige Smith. I'm an associate corporate attorney with Stradling Yaka that's based in Newport Beach and has offices all over the West Coast. So my practice focuses on working with startups from their formation through whatever exit or liquidity event they might have, whether it be a merger or acquisition or an IPO. And I also work with public companies on their day-to-day disclosures. So I love, getting to sit in on panels like this and help advise people, especially when they're at the beginning stages, because I really believe in the work that everybody's doing here. And I really have enjoyed working with SBDC and UCI over the past few months. So it's a pleasure for me to be here too.
So you guys are very lucky to have both Paige and Monica today. So what we'll talk about today is advisory boards, negotiating compensations for both advisory boards and your key hires. We'll talk about employment and compliance. And because SBDC is not allowed to give legal advice, I will completely stay out of it. And I know that Paige will probably also tell you that no matter what she says, it still does not count as a legal
That's
advice.
Right. That's right.
So back to the investable startup idea. So what makes an investable startup? And we'll kind of tackle it one module at a time. But an investable startup is a startup that has a unique value proposition, and we talked about it in our first module. It's a startup that has an attractive market size, which means there's an opportunity to make money. It's not a guarantee, but it's an opportunity. Team that can execute. That is a key to an investable startup. And you will hear investors talk about the team being the most important thing that they look at. Now, we have it as number 3, and there's a reason around it, is you need to have a business. So when we talk about understanding your business, you're not building a business around the team. You build your business around your value proposition. So even a great team cannot substitute for a great value proposition or compensate for market size. You will hear a lot of investors say that you have to talk about the team first in your pitch sometimes, because that's what investors want to look at. We'll address that because there are times when you put your team slide right at the beginning of the presentation to investors, and there are times when you don't, and we'll kind of explain that. Again, the final piece of the investable startup is, what do your financials look like, and how well do you pitch? What's your pitch deck like? And that we'll address next week. So again, those are the components: unique value proposition, attractive market size, team that can execute, and it's a startup that makes money for investors. Otherwise, it can be a great business, but it's not an investable business. So we wanted to start off, and we'll all chime in. All 3 of us will talk about it. There is a purpose of advisory boards for startups versus late-stage companies. They're slightly different, but some of the things are absolutely the same across the board. So when you're building your startup and you have an advisory board, there are people who advise you, and then there are people you put on the advisory board on your slide and your deck. right? And it's the same thing, and Monica can talk about the importance of having solid advisors that can also help you with a lot of issues beyond just your business. And then again,
Absolutely.
and Paige will talk about compensating them too. Um, but for a startup, your advisors have to, for better or worse, look good on that pitch deck slide. So they should be people who can help you move your business forward, not just behind the scenes, but they have to look good to investors. That makes you investable. Again, what do advisors look for? Investors look for in advisors. Advisors are there to not just guide you technically. They're there to help you open the doors. So their network is extremely important to investors. Are they people who have credentials? Are they people who can make phone calls? And will they make those phone calls on your behalf? And, there's a difference between mentors and advisors. You can have a lot of mentors, and that's your support system. Even as a CEO, you should have your own personal advisory board. And that board are people whom you know, whom you trust. They can be your former professors, they can be your friends, they can be your former colleagues, but they have your best interest in mind. And there's a difference between your interest and your startup's interest sometimes. And what is good for you may not be good for the startup. What's good for the startup may not be good for you. Treat those things separately. Um, so, Paige, I will turn it over to you to talk about the qualifications for advisory boards.
Sure. Yeah. So when you're trying to figure out what you need on your advisory board, this is unique to every group of officers is going to have to determine when you're seeking investment, really assess what your strengths are and where you have holes. So for instance, if you say you're a CEO and you have excellent marketing expertise and you're great with operations, but you personally don't have a tech background and you're attempting to build a tech startup, I think it's very common actually that there are officers of companies who are trying to have tech companies that have not gotten investment yet who need a CTO. The issue is that if you don't have money in the door, it's really hard to attract talent. So it's hard to get a CTO who's willing to come on full time before you're invested. This is a really good opportunity to have someone on your advisory board, because I think it's understandable, and we shouldn't have the perspective that, if you don't have a tech background, or if you're trying to do a medical device company or something like that, if you don't have industry expertise, you should still be permitted to operate in this space, but you're going to need help from people to help locate that talent by the time you're able to attract capital. So when we're looking at qualifications, before the necessary step before that is to really assess what are your blind spots, what are your weak spots that potential investors are, maybe going to try and poke holes in your thesis by saying, okay, well, you're in this industry, but you don't have you're trying to sell frozen foods and you don't have anyone in the packaged food industry on your board, So you find someone to fill in the weak spots. So then when you're assessing who you should be adding in terms of qualifications, you want to look at people who have had success in the space. Ideally, if it's a startup, then they've had kind of a traditional startup exit. But it's okay if you find someone who, let's say they've been on the board of a public company in that industry for a while, or it's someone who's been an officer or in operations, or just has extensive background in that industry, to where they could open the door for you to make referrals to people within that industry, even if they're not going to come on board as your CTO or as whatever advisor, whatever potential officer in the future. They're going to be able to introduce you to the person who is. So Laura brought up a good point, which is there's a difference between mentors and people for your advisory board. I think that what you should be thinking is, whenever you're interviewing someone, does this validate that I am investable? Does bringing this person on help add weight to the fact that if I'm not able to answer a question or face a challenge that I'm presented with, this person is going to help me get there. It's not just someone who, is an impressive personality or who has a lot of business experience. It's someone who is really narrowly targeted to your space. So to actually answer the question, getting to compensation. So how do we compensate advisors? It depends on, what stage you are at in your life cycle. But for most startup companies, your funds are really limited and you need to be really conservative about how you deploy capital. So traditionally, to serve on an advisory board of a smaller company, granted it's a business decision, but most often advisory board members would receive 25 basis points or 0.25% of the cap table. Oftentimes there will be really light compensation in terms of cash compensation. What I encourage companies to do is set up an advisory board agreement that would have confidentiality provisions within there, and then just provide that anyone on your board is going to be paid quarterly, and usually people get paid a few $100s. It's really de minimis in terms of their participation to begin with. And so for the advisory board members, it's often, I don't want to say it's a favor, but it's definitely no one's getting on an advisory board, for the compensation for early stage companies. But definitely if someone, and to that end, the expectation should not be that they're regularly engaged in your day-to-day. It's more that they are willing to show up for you when you say, hey, I need someone who has like 10 years of expertise in email marketing. They'll be able to help there, but they're not as involved in the day-to-day.
Monica, do you want to address any sort of HR related issues when it comes to advisors versus teams?
Yeah, I think that, when you're looking at transitioning somebody over, whether this person is going to be a contracted, a 1099 contractor for your company until you can raise funds to bring them on full time, understanding the difference between a contractor and a W-2 employee is really important. That is something I see happen most often in early stage startups, where you have some folks that are working for the company and they're pretty much logging in full-time hours, exclusively just working for the startup. So just being able to understand from a compliance perspective what's required for you as a business owner, and treating your company as a business, and making sure that you protect the business from unforeseen liability and exposure when it comes to having a contractor versus a W-2 employee. So that is something that I highly recommend people just look into and do a little research on.
Yeah, and a lot of times advisors come on board sort of, there's no agreement, right? And like Paige mentioned, she advises to put something in writing. But a lot of, the truth is a lot of times you get a pitch deck and there's someone on the advisory board and you ask, well, does that person even know that you're on the advisory, they are on your advisory board? And the answer is, well, they help me a lot and they're always happy to help. That's different because I've seen sometimes all of a sudden I see my face on the advisory board and I'm like, I'm not even allowed to be on the advisory board. I worked with you through SBDC, and to me, that's not even admissible by our agreement.
Yeah, that's a good that's a good point. And it's actually really, that brings up something important. Yeah, you cannot, you don't have the right to use someone's name and likeness on your deck to promote your company without their consent to do so. Obviously, I'm the attorney, so I'm overthinking things, but it's not just a best practice in terms of being clear about what your relationship is with your advisors. But it's also, for the reasons Laura's bringing up, it's really important because you want to be clear not only about your relationship, but also, to the extent you're asking people a lot of questions and giving them a lot of feedback about specifics about what you're doing, you really want them to be subject to a confidentiality provision. And you put that in your agreement with someone on the advisory board. Granted, if you're just kind of having loose conversations with them, it's not a huge deal, but I think the point of an advisor is that you're able to really share with them kind of the secret sauce about some stuff, and that helps them facilitate additional relationships.
Mhm. And Paige, do you advise startups when an advisor says, "I'm fine, I don't need to be compensated yet"? In those cases, what is your advice?
That's actually pretty common. A lot of times people, they don't, for whatever reason, oftentimes it's tax related, they don't want to have anything on their balance sheet. That's fine. You can have, so long as, I would still say that we're going to compensate you for out of pocket expenses and things like that. Arguably, you can't enter into a contract with someone without there being some form of consideration, but I'm not super concerned about it. I've never really seen any complications arise from that, and it's pretty common. What I would say is that, you can always be revisiting the nature of your relationship with someone. So if they want to be on the advisory board, um, and maybe they want to deepen their relationship with the company or come on full time or something like that in the future, then you can talk about, okay, what is your compensation really going to look like? But yeah, oftentimes, people are happy for the publicity, to be able, or it
Or
just
it's
personally
intellectual,
satisfies.
yeah, yeah, exactly. It's
Right.
intellectual
Yeah,
stimulation. And just
exactly.
giving
Yep.
back. Yeah.
Yep.
Question that sometimes comes up is, can you compensate advisors differently? Meaning one advisor gets one percentage of equity, another one gets a different one. Any advice and suggestions around that issue?
Definitely. So you certainly can. This is very common. And oftentimes there's an assessment. Some advisors are more useful than others. And so some people are there, frankly, to help validate, to show that you have a safety net underneath you. And others are more, they're going to function a little bit more like boots on the ground, and that you expect to be speaking with them more regularly, and you would make sure that their equity, in those cases, maybe you give them 1%, or maybe you give them, 0.5% as opposed to 0.25. The one thing to know is I'm often asked, well, are they going to find out? Is there a way for them to find out? Technically, yeah, if they're going to be a stockholder of the company, if they're ever to exercise their option as a stockholder of the company, they're entitled to see the books and records of the company, and they could see that. So I think, if you're kind of compensating people differently, regardless of the value they bring, then it's something to think about. That's kind of a down the line concern. But I would say, if that's the case, I would wonder why, to me, so long as there's an argument to be made for why someone's being compensated differently, then it's okay. And some people, they don't want equity, they just want cash, and maybe you can make that happen, and it's better for the company not to give up its equity in this case. But as long as you're aware that they might become aware at some point of this different compensation, then I think it's fine.
Mhm. And we'll talk about compensation later. And Monica, I know you have a lot to say about that when it comes to key hires. But one issue is when an advisor becomes sort of a dead weight, meaning they got on the pitch deck because they looked really good to investors, but then there is nothing happening. And those conversations can be awkward.
Yeah. So there are 2 points here. First of all, another good reason for a contract. If you have a contract, and the services could be provided at will, and so you could terminate their services at any point. Typically, the way an option plan is set up, if you were to grant your advisory board member an option, it vests until their termination of service. And the standard option that you would grant someone would be a 4-year option with what's called a 1-year cliff, um, meaning that the option you'd grant them, none of the shares subject to the option would vest until 1 year of their service has been provided. Sometimes for advisors, people set it to 6 months and they make it a 2-year option. But let's just say, saying it's a 2-year vesting period, let's say they're there for 8 months, they had a 6-month cliff. That means by the time of their 8th month, if it's just not working out, only a little bit more than a fourth of their option would have vested. And so that's kind of minimal damage done to the company, and you could terminate their services at will. And so you're pretty much in good shape there. But my main point is to say that you want to make sure that if you grant them an option, it's subject to vesting. It's not just an option to purchase shares with everything vested outright. But if you're working with an attorney who works in startups, they'll know to build that in.
Yeah, I think the issues arise where there is no conversation with an attorney, or there is no attorney to even have a conversation with, because there's this big scary thing about having to pay.
Right.
And
Yeah.
so before you know it, someone is pitching to investors, and there are all these people on the slides. And then during due diligence, that's when those things come out, and all of a sudden the due diligence can go completely wrong because of some of those issues.
There's a little philosophy around that, Laura. You know, it's as far as buttoning everything up, it's better to do it in the early stages with somebody like Paige, an attorney that can really get you up and going the right way, as opposed to having a really successful company and the infrastructure that was created is a mess. I think it's, do you want to pay today or tomorrow sort of philosophy. So yeah.
Yeah, there are a lot of issues with, with compensating team members too. And so I wanted to kind of move forward a little bit, and we'll come back to that. This is an example of a Teams slide. This is something that you will see on the pitch deck. I know we keep talking about throwing people on the pitch deck, so that's where they are. You will have a team slide, and you will have an advisory. Do we have an advisory? No. It looks exactly the same. So one would be called team, the other one would call advisory board. If you don't have enough people, yes, you can combine them on one slide. Ideally, they're separate. So what do you want to put on the slide as far as the bullet points? So you don't want to put a slice of the resume. You don't want your font size to be so tiny no one can read it, in hopes that just because there's a lot of text, someone will be impressed. You pick things that are relevant for you as a startup. Someone can be very impressive. They can have accomplishments in other areas. They can have titles, but you pick what is important to you, to your startup, right? So let's say the founder and CEO. Right? Notice here, I'm not even putting down what degree they have. Right? That's irrelevant. 2 successful exits, 15 years in the industry. That's all the investor wants to know, really. And trust me, they can ask you questions. If they're curious, they will. Again, if it's VP of sales and marketing, you can put down logos of the companies where the person worked before. Sometimes that's one way to save sort of space on the slide. But even for that, you want to highlight something that was the reason why you chose that person over another person. So again, your VP of sales, right? Top salesperson at LG, deep industry connections. Again, why is that more important than where he graduated from? Because your startup needs those industry connections. That's what investors care about. That's what makes you more investable. The other issues, remember I said that it depends on the situation where you put the slide. Sometimes you will be told, oh, you got to put the team slide first. That's almost like after the introduction, that's where your team slide goes. And sometimes you will be given feedback, nope, your team slide can be somewhere in the middle. So let me address this issue. If you have a team that is just screaming success, multiple exits, that's the time to put them on the slide before you even talk about what you do almost. I mean, what you do is it goes on your first slide, right? When your elevator pitch, that's when you say, hello, I am such and such, and our company is solving this problem by doing this, this, and this. And your quick elevator pitch is then followed by the team slide. That's the time to put it up front. If that's not the case, where you can sell almost the entire startup just based on who is on your team, this is the time to do the regular sort of more traditional layout where you talk about the problem, you talk about your solution, the business model, because by the time you get to the team slide, it makes more sense why those people are on the slide, even though they haven't had 10 exits, and they don't have those traditionally impressive resumes. Because then an investor already heard what you're doing, what your space is like, how you're selling, whom you're selling to. So now looking at your team, it doesn't matter that they maybe only had a few years at a certain company, but that company is in the industry that is key to you, and that can be a strategic partner. So that becomes more important. So when we talk about the team, again, investors, you will hear investors say that they are betting on the horse, which is your business, but they really have to be in love with the jockey, which is the CEO. So one note is you always have to have your CEO pitch. And then your team has to be solid enough to back you up and carry you over the finish line. So when you're building a team, negotiating compensations, we already kind of mentioned that, Paige talked about gaps, right? You fill in gaps with advisors, but you also have to make sure that there are no gaps in your team. So I'm going to go back to the slide for a second. So what are the critical components? If you are in tech, you need to have your CTO, right? If you don't have a CTO, put down a little avatar and put down TBD. That communicates to investors that you know that you need that guy. And that's your key hire that will happen. They're usually looking, so obviously CEO, right? That's your first, that's your jockey. They have to be in love with you. Someone has to be responsible for sales, marketing, or business development. So you have to have a person in that position, or again, TBD. You have someone responsible for your tech or your product or your service, someone with again, nuts and bolts. It is nice to have a COO, but who's focusing just on operations. Do you need to have a CFO? That's the question sometimes comes up. You can have a fractional CFO, and yes, you can put them on the deck. Is it critical? Yes and no. And Monica, you have your opinion as to fractional, whether it's fractional HR, fractional CTO, fractional CFO.
I think that having somebody like a CFO, whether it's fractional or maybe somebody that like an accounting team that's helping you calculate your job costing, your burden, knowing the numbers is going to be important in this process, especially when you're trying to be investable and getting investors to invest in the company. I think that financial component can be something that'll hold a business or a company back from getting investments. You brought something up that was really great, Laura. For example, the CTO to be hired, somebody that maybe isn't, that spot or position isn't filled yet, but knowing the cost to bring that person, that key hire on is incredibly important. And so having, I don't think that as a startup, you don't have, there's no need for a full-time CFO, but like you mentioned, somebody fractional, somebody that can come in and provide some figures and cost and give you an analysis on what that would be, what the burden would be to the company, and that there's some value there.
Yeah, so that brings, Monica, opens up another big sort of question, and that is compensation for the team. And I know that we see it a lot, and there's there's no way to ignore this, but there are a lot of times when startups will put on their pitch deck, under their financials, the salaries, and they're putting down $300K for someone. And that's a no, unless you just had an exit and you're the one who was the second person who started Google. You're not getting that salary off the bat. However, the argument is on the startup part is, well, we have this person who is critical to our survival of the business, but he's used to making that much money. How do I'm in between the rock and the hard place? How do I do it? Now, the first, and Monica, I'm going to turn it over to you as far as how to get those people, apart from doing fractional, someone fractional. But one thing to remember is, if you're bringing on someone not on the advisory board, but on the team, who was in the corporate world, who is requiring that type of a salary, it's a blessing and a curse. And investors know it. When they see 300K salary, not only they're saying, I'm sorry, I'm not supporting your lifestyle or lifestyle of your team member, but they're also looking at it as, okay, this is someone who's used to that type of a lifestyle. They're expecting that type of compensation. They're in the corporate world. Have they had any experience in the startup world? And it doesn't count if they were 20 years old when they had that experience, because if they got used to a corporate world, it can be a damaging thing to your startup. And countless clients I have seen that hired people that paid through the nose, actually out of their own pocket, only to have that person leave because they were butting heads. They just could not agree on things. And before it even got to funding, there were exits, and they were not pretty, because attorneys get more involved when someone from the corporate level is on your startup who actually knows the law much more than you do, and is upset. I don't know, Paige, I don't know if you want to jump in on that one.
Yeah,
Yeah.
I think it brings up a really, really important point, that, a lot of people, startups feel exciting and everything like that, and it's a hot topic, but, the reality is that startups as a business model and as a lifestyle and everything like that, they are not for most people. And when I say that, I'm not just saying that, because the people who are interested in startups, they're just better than everybody else. They're more willing to take on risk. It's because financially speaking, it doesn't make sense. For most people have not had these huge exits, and we're living, I'm not sure where everybody's based, but let's say we're living in California. If you have dared to have children, in California, it's hard to do that without an income, and it's really, if you've been operating in tech for 10 years or 20 years and you've worked your way up the ranks, working with a startup is not appetizing. And I think it's something that if you're a CEO attracting talent, you need to have really brutal and honest conversations about the reality that if the company does well, it's going to be a very long time from now. And for the most part, if you are working with talent that expects, high compensation, they need to be an evangelist of what you're doing at a minimum, because otherwise it's really not going to make sense. And for you to be an investable entity, oftentimes the entities that are easier to invest in are the ones where the true evangelists at the helm are the ones that have the key skills needed to make it work. Because if it's my company and I'm also the talent, then I'm more willing to take a risk, because I know there's a direct relationship between what I do and the success of the company. And so maybe I can live on my own savings for a year or something to make it happen for my company. But if you're bringing someone else in, then it's much harder. So again, I encourage really honest conversations. The other thing too, before I hand it off to Monica, but is to think about, what are some ways, what I suggest oftentimes is bring a CT. If you think you found your talent who is really going to help, but they're worth 300 a year or something like that, and they might legitimately be worth that in the market, it's better for the company to maybe bring them on part-time and say, at the time of the investment, we're still not going to pay you 300K. It's going to be about half that. But you can be more flexible with them on timelines. You can be understanding about them working on other projects. I have found that, one of the ways to bring in better talent while also helping them, work with you at a lower rate is just understanding it's going to take longer for them to get something done for me than it usually would, because I'm going to let them kind of do this more on their off time or something like that. But that's usually people want stuff now. And so, that it's it's up to you in terms of if that works for your business model. But those are some circumstances where I've seen that work.
Yeah, and you actually almost answered one of the questions that we have in the chat box. What are your views on team who, instead of putting financial burden on the startup in the beginning, is compensated once the startup generating income? So partially, I'm saying partially you answered it because you said in the conversation, we're going to have you as a fractional, position. And then when we get funded, you're still not going to get the 300K. So that's partially the answer is yes. It doesn't work that way to simply shift to that imaginary time or line in the sand where the startup gets funded, because that's investors' money. They still don't want to take the burden now on themselves to fund that person. Now, the question was actually once the startup is generating income, which is different from the startup getting funded, right? So if you're generating income, that's absolutely, and I'm going to have Monica talk about it because that's your bread and butter. That's where you can have those conversations and set up compensations based on performance of the person and the performance of the startup. So Monica, I'll just hand it over to you. How do you get those key hires? How do you negotiate with them? And just so that I don't forget, I definitely want to address the generosity of a startup with equity before we finish today. So please remind me to raise that red flag and address that.
Absolutely. Well, with regards to the key hires, I think both Paige and Laura, you touched on some pretty important aspects of that, is really finding when you have a small and mighty team, I can't emphasize leadership and how important leadership is. And that really falls on the shoulders of the CEO, right? There has to be a clear culture that the company has, even if it's small and mighty with 4 or 5 people to start with. Having a mission statement and having everybody who joins on marry that. How do you do it? We talked a little bit about those key roles and how you bring those key folks on. I think for my clients, my startups that I work with, a lot of times they actually will find someone who's semi-retired in that industry that has a really strong business acumen and isn't necessarily doing this to fund their annual overhead expenses. They're very well established already. And so they're doing it more from that philanthropic side, right? They want to give back, they want to mentor, but they want to be a part of this business, whether it's having some sort of equity into the business, or maybe it's a salary and they're willing to take cuts. I see that all the time, but you got to find the right person, and you got to find the person that's not going to be passive, someone who's going to really jump in there, roll up their sleeves and get you going quick. I think that lends itself to having and being strong when you're pitching or looking to be investable. One thing I talk a little bit to my clients about is when you start to identify those key hires and bringing people on, what does that look like, right? You may start that, I touched on this a little earlier, you may start them on temporarily as a 1099 contractor. They can do some work, some advisory work for you in the beginning of that early stage life cycle. But when you actually become profitable and the business is bringing in profits, how do you convert them over? You may want to shift over their role from someone who's just fractional part-time contractor to now a full-time or maybe even a part-time employee. So what I generally do is for my clients is we put together compensation statements or reports. This is an example of one that gives you a good idea for recruiting and bringing those key hires on. Aside from salary that you're going to offer, maybe your agreement is $100,000 a year and in the form of a salary. What other benefits are you giving them, right? Especially when you're doing that 1099 conversion to W-2. As a business, you're responsible for those employer-related taxes and paying those taxes. I think if any year taught us to be pretty pliable when it comes to remote working was last year. So I'm starting to see a lot of companies hire talent outside of California. So you have flexibility with that, and understanding taxes, employer-related taxes in every state. It's very complicated and it's different. And the responsibility does lie on the employee or the business. So being able to know what those taxes are, put that into your compensation statement, because you are paying a percentage of the and now employees' taxes, so they understand what that is. If there's any fringe that you're going to offer, maybe you had a great year and sales did great for the business, and so now you're able to offer benefits, right? Because you need to compete for talent. They may take a lower wage, but they are expecting to have benefits. Maybe if there's an emergency, they need to go to the hospital, or have benefits for their children or their spouse. So when you start to put that compensation together, being able to calculate what's my overhead exposure when it comes to medical benefits, dental, vision, life, how do I compete with the Allergans of the world or the Googles of the world to get top talent in? And some folks, I mean, just like not-for-profits, they may not offer the best salaries at the beginning, but they really do emphasize a rich benefit structure to get people in and get them married. And then aside from those, having some level of equity, but being able to calculate what that cost is above and beyond just their gross salary is important. And it's important to show people.
Yeah, and I think it's also
reports.
important to know, because a lot of times they overpromise and then they don't realize how much it will cost them, right? So if they are being, they're calculating on the back of the napkin. It's like, well, this person will get, and again, 100K is pretty much the top of what you're going to be offering. When Monica said 100, that's your top. You're usually looking at 60K as being comfort zone for investors. But again, even if you're offering 60K, sit down with someone like Monica, right? Someone who can actually calculate, use the tools that she's using to figure out how much it would actually cost you, because that 60 is not going to end up being 60, right?
Absolutely. Absolutely. And knowing your numbers, I can't stress that enough. Knowing your financials, knowing what your current burden is, your job costing burden is important, right? Are you running on 25%, of your gross payroll costs to cover everything that the business needs to protect it against liability, right? Workers' comp insurance, EPLI insurance, taxes, fringe, all of those line items. Going and knowing those numbers just makes you a more investable company. You look strong to the investors. They know that you know your numbers. They know that you have a strategy around when you're going to recruit and how you're going to recruit. And having access to different tools aside from this total compensation statement, but having access to salary surveys, knowing, what your competition's paying for people in that industry, whether it's a startup or maybe an established company. So you know where to meet, right? You know where your budget is, you know what to offer, even if it's from an equity standpoint. You're able to come in with that key hire, and you got to sell that position to them,
Yeah. And that kind of goes back to knowing your numbers and trying to be fair, because what is fair on the marketplace for someone who's working for an established company is not necessarily the same thing that's fair. And I want to go back to the cap tables because, and I think it can go all the way back to the advisory boards and those compensations, those seemingly tiny percentages. And Paige, I think you talk about the cap tables when you sit down with clients. And all of a sudden, all those percentages start shifting once they realize what the cap table looks like, and those percentages start having some dollar signs attached to them.
Yeah, exactly. What I would say is, when you are at the time of your formation, when you're trying to figure out what everyone's percentages should be, something that you need to build in is your equity incentive plan or your pool for bringing on talent. But even more so than that, and again, you can find cap tables online that can help model this through. But one thing that is important to do is to do a model of what the company will look like after its first investment, its first traditional, 1.5 or $2 million venture capital investment, if that's what you're targeting. Because what you'll see is that if you don't build in an equity incentive plan, and if you don't account for, the fact that you're going to have to retain your talent and everything like this, you'll quickly see that the founders get diluted quite quickly, even after the first round. And, typically there are more than, 1 or 2 rounds of financing before an exit. And so I think it's important to see what the company will look like. And granted, if you continue to raise, there might be opportunities to grant the founders additional equity out of subsequent rounds, but it's good. What I find is that when people first start a company, and it's good, you know, I think it's coming from a good place. They want to compensate fairly, and that includes giving them equity. And it is good to make sure your advisors and your key talent are receiving equity, but what the actual percentages are oftentimes should be much more modest than what's originally contemplated. So, you know, even if you're replacing a CEO, oftentimes if it's not a founder CEO, they wouldn't get more than 5% of the cap table, which surprises a lot of people. And key talent, like you know, if your CTO is not a founder and they're a fractional CTO, even though they're quite valuable, it's good to be a little bit more modest with their percentage. And what I say is you can always grant more, you can't grant less. You know, you can't take away what you've already promised someone. So it's something to be really mindful of when you're starting out.
Mhm. I wanted to shift gears to liabilities and IP. And sort of the liability will come in as far as all the employment pesky things that we have, especially in California. And then intellectual property is the area where I wanted to talk about the vendors, especially outsourcing, and all of it will come out in due diligence. It will look great on your deck, but it can look a little nasty during the due diligence if you don't keep things clean. Um, so maybe Monica, maybe you can talk about the liability when it comes to your HR issues, and what do you see happening, good and bad, and what you need to look out for to make sure that you don't have some nasty surprises.
Yeah, this is a really good topic. I recently talked to a client, or a prospective new client that now is a client, about 2 months ago, and they had a really uh, startup bootstrap company. They had an issue with a W-2 employee and a 1099 contractor, and a conflict happened. There was a little bit of a yelling match. You know, the contractor told a female W-2 employee that she should know her place and not, you know, invade his space, and he knows what he's doing. So you can only imagine that the poor executive team, they're probably frantic, to say the least, but they reached out to me. And so they said, Monica, what can we do? This is a huge issue for us, in the sense where it's a liability exposure. The investors are concerned about it, and they want to know how they can, how we can help protect the business. Main thing, this startup had, they had workers' comp, but they had no EPLI insurance. EPLI insurance is the employer practice liability insurance. And where this particular situation got sticky is that you have someone who is actual employee of the organization and someone who's a contractor. And where does that liability lie? That was the question to me by the team, the leadership team at this startup. It's with the leadership. It's with the company. They're liable for anything that happens between any contractor and employee, W-2 employee. So I can't emphasize enough having that infrastructure, making sure that the business is protected, making sure that there's workers' comp insurance in place, making sure there's employer practice liability insurance. If you're going to invite contractors in your organization, which you will as a startup, that's inevitable, making sure that they come in with their own insurances as well, their own EPLI insurance, their own GL policies, having a policy around hiring, a best practice policy around hiring contractors, so that they're also protected, is important. Whether it's something, you know, these insurances are built into their compensation that the company will pay for, or they have to bring it in on their own. Just having a checks and balances, because these are things that investors look for, and they want to know how much liability are they walking into, whether you're going to be acquired or whether they're funding you, right? It's they're opening their wallet. They want to make sure their money, their investment is protected. So that's one layer of it. And also compliance. I mean, let's be honest, running a business in California, being a business owner, is not easy. There is so much red tape and compliance related issues with running a business that you have to be pretty privy on what's changing. And with that landscape, you know, most of my leadership startup teams didn't go into business to be HR experts, but it's a necessary evil. And being able to partner with someone that you can just outsource that. You don't, when you're small and you're bootstrapping it, you don't need somebody in the operations when you're little, and when you're really growing and trying to hire, folks that are going to be key players for growth, give it to an expert that can manage it for you. And you can call, they'll give you direction, they'll give you some advice, but liabilities are really, really important.
Shifting gears to IP, and Paige, I know that you had cases where mergers and acquisitions did not happen because IP was not protected. I also want to sort of address the issue of outsourcing, where there are no clear guidelines. Because there was no agreement, there's nothing been in the contract, where the startup assumed that what they outsourced to the vendor, the IP will belong to them, and that was not the case. So if you can talk about those issues, that would be great, I think, for
Yeah.
our audience.
Yeah, for sure. This is actually, it's so very important. It's one of the most important things when if you're a company where IP matters, which is most companies and almost all tech companies, it's really important to have an agreement with all of your employees, which is called a Proprietary Inventions and Assignments Agreement, or PIAA, whereby they're saying that anything that is invented by me, or that I'm, developing or contributing on behalf of the company, I agree in the future, I will assign, and I hereby do assign to the company. It's really important to have very specific language in that contract, because if it just says, I agree that I will assign on some future date, I have seen really $300 million M&A deals get put on pause and die because a one sentence in a PIAA in the first week of a company's founding just said, I will assign this, which means it's a whole negotiation. If you have to go back to that person and say, oh, could you sign this paper? Oh, why would I need to do that? Oh, because suddenly it's worth millions of dollars. Yeah, I'm going to need to get paid for that. It's really important. And again, if you have a good attorney, you have good IP counsel, they should be on top of that. So I don't want you to feel like, you have to remember that this provision be in there. That really is your attorney's job, but it's important that you have your employees sign that. It's also important that you have agreements with your contractors, with your vendors, or if you're contracting to someone who uses out, who outsources part of their team, that's very common. They need to be representing to you that they agree that their work is work made for hire, which is a specific term, that means that in this state, everything that they're doing is assigned to the company. That alone is an important reason to have, to contract with anyone who's contributing meaningful IP to the company. So if you have a flow chart in your head, if you're thinking, do I need an agreement with this person? The thought should be, are they doing anything that actually matters? If yes, then let's get a contract, because you want really clear assignment. And even if, a lot of the times people will say, hey, this is with my uncle's company and we're so close, we really don't need to paper anything. He would never do anything to harm me. And I really believe that. And that really is the case. A lot of the times we see companies where there's some kind of family relationship where in earnest, those parties are never going to go after each other. The issue is not actually between those two people getting in a fight. It's with a potential investor or acquirer of your company later saying, yeah, I don't care. We're taking you public and you need to get that documented now. And sometimes the fact that there's not an agreement in the first place is enough to scare someone off. Even if you really do have a great relationship with that person, they're happy to paper it.
Yeah, well, the other thing is, it just came to mind, what if the uncle died and his wife is not so generous and she's not going to sign that agreement?
Yeah, and I actually see that scenario more, which I guess is a good thing about the world. I see people, trying to get like a money grab less than an investor or someone trying to buy your business, more put off that there hasn't been something documented, and then that's scaring them away. So you can think of it also just as a way to kind of grease the wheel, just to make your company as clean as possible. And you can say that to your uncle if he's put off by, you asking him to sign a contract. It's not that I don't trust you, it's that some third party isn't going to trust our relationship.
Mhm. And, so I think we've addressed everything that's on the slide, and at this point, I will like to open it. If you have questions, open up your mics, and please ask me, Monica, or Paige anything that you can think of that's related to your advisory boards, teams.
I have a quick question.
Mhm.
Yes, E&O insurance, and and Monica, you just answered that. I first heard of this recently, and what is it, and why is it of value?
It's an insurance that's usually carried by the directors and executives of the company, and it's just errors and omissions, protects you against any um, and correct me if I'm wrong, Paige, but it protects you against any misinformation that you give on behalf of the company, because you're carrying that executive title. So it's really important to have. I'm a huge advocate of having insurance. Some people would say you don't need it right away as a startup, but I think that there's value of having protection for the business at any level. So
I'm actually doing some bids for some cities in the state right now, and they're requiring insurance. And so it's funny because one of the bids is on independent contractors and combining employees. So I was like, oh, put that one down. The other one, and but I want to make sure I have all of my insurances lined up, and
you're doing the right thing. Start it now. Have some sort of process around it. Create a checklist of making sure that you have all the necessary insurances really to protect you and your personal assets.
all right, awesome, thank you.
You're welcome.
Yeah, I would have a comment. First of all, I want to thank you for this very helpful updated presentation. When I go back in my experience, things have remarkably changed today versus the way we used to operate. So saying that is a lot to be said. But one point is this, is I'm working on the COVID and on variant testing. And one of the elements that I'm concerned with is we have soft science, we have hard science. So this becomes very convoluted and complicated in the genetic testing and some of the short-term values versus long-term. That being said, what concerns should we have regarding the transitions that occur in technology, and in an example with COVID and variants, et cetera?
So I want to make sure that when you're saying what concerns you should have as the technology evolves, you mean from like an IP perspective, or how are you setting things up? I just want to make sure I kind of narrowly answer your question.
Well, so specifically, you get into what we call hard science. So it gets
Right.
very complicated, obviously, on the COVID. And everyone's been humbled. It's confusing, and we don't have the answers in the future. We don't know. That's the intelligent approach. That being said, how much of a concern is that for investors? Just being honest and forthright that, hey, nobody knows.
Yeah, I think that gets down to when an investor is evaluating you, there are two forms of diligence. There's the legal diligence and the business diligence.
Mhm.
What you're kind of getting to is the business diligence. And I think that's where it comes down to you being really clear with, this is what it's addressing today, but you can give disclosures about, to the extent there are any kind of forward-looking statements that we're giving in our investment presentation. There are so many risks that are presented, and that this is an evolving science. We can't predict what the variants are going to do in the future. And so we're speaking about the value of our company today. We can't predict what's going to happen. It might be that a variant comes out that invalidates everything that we're doing. I think it's really important whenever you put together investor presentation, usually in decks, like for startups, you don't see a lot of forward-looking statement disclosure because it's kind of understood, anything could happen. But if
Mm.
you're in a space that is, highly subject to risk, I don't think it ever hurts you to just make it really clear that, and I think the important part is that if you're giving a disclosure about potential risks, that you're really specific about them. You don't just say, hey, the world can end tomorrow. You say, it's the variance, it's, this particular element of our technology that's subject to risk. Again, this isn't legal advice, but that would be my approach to investors, is to be really clear about, making them aware of any risks related to what you're developing.